Boy, oh boy, do we have an interesting topic for you today. Interest rates are always changing, and a lot of people will be completely paralyzed by fear, whether
Oh,
it's buying or selling a house. So today we want to talk a little bit about how interest rates affect you, whether you're buying, selling, or investing in these markets. So Tom, basic question, how much does a 1% change in interest rate affect your monthly payments on a mortgage?
yeah. That's a great question. So I have a kind of a rule of thumb as I think things through, and I'm working on them with people and having conversations. I remember a sticky point is that for $100,000 loan at a 6% rate, your payment is $600, right? It's right there. It's an easy number to remember and judge off of, right? So if you're talking about a 6% rate, a $200,000 loan is going to cost you about $1,200 a month. That's obviously without taxes and insurance. That's just the mortgage payment. If you go up to a 7% number, you increase that by about 10%, which is about 660. It's actually, I think it's 665 to be precise. So now you're instead of a $200,000 house costing you $1,200, it costs you $1,320. So there's your impact of a 1% rate, and depending on how many hundreds of thousands you buy, you just do a little bit of math. And one thing that I always try to counsel people on is not putting themselves into a position where they're house poor, where the payment is so much that they have to stretch to afford it. They have to go drive Uber or deliver pizzas or any of those other things just to afford the house, because you've put yourself in a situation where one little slip up, one hospital visit, now you're in trouble, right? So just because the loan officer says you're approved for 350 doesn't mean you have to spend 350. You can spend 300 or 320 and save yourself that little bit of money.
So is it better to buy now at that higher rate or risk waiting for a lower rate and possibly go up more?
Yeah, I mean, interest rates are they're in a market. A lot of people think that they're controlled by the Fed rate, right? So they hear things like, "Oh, the Fed's cutting the rates." Well, often when the Fed cuts the rate, we actually see an increase in mortgage rates because they're not directly tied. The mortgage rates are tied to the 10-year Treasury bonds, and that's a market, right? That's where investors are buying and selling. And so that same, and it's not little investors like you and me, right? It's institutional investors that are moving millions and billions of dollars. When the equities market is doing really well, right? Stocks, when the equities market is doing well, money flows into the equities market. Well, that money is coming from the bond market. So the bond market has to raise yields, which lowers interest rates, or raises interest rates rather. So that's why your interest rates go higher. When the equities market tanks, that money goes into the bond market, which lowers the yields, and you get better rates on your mortgage rates. So it's always a balance, right, of what's going on. So remember, the historic 40-year historic is about 6%, 6.25, something like that, right? So if you're in that range, you're in the norm. Having 2%, 2.5%, 3% loans was way abnormal. Probably shouldn't have ever happened, or when it did, it shouldn't have lasted so long. And people don't remember that we had several of those events prior to the 2020 pandemic, right? Where it went super low. We had several times where it was like 4% was not uncommon, 3.5% was not uncommon, all the way back into 2015, 2016, right? So there's been a long history right now. If I remember correctly, at the moment, 60% of all current mortgages are under 4%. There are many people that are making the financial decision to stay in a home because they have a great interest rate and not sell it, even though they might want to for other reasons. They're choosing to stay there and suck it up, or they're choosing to stay there and maybe fix it up.
So how can buyers beat high interest rates?
So there's no cheating the system, right? The system is the system. So there's managing the system, right? So the biggest things that you can do to get the best rates is, one, have a good credit score. Credit scores are vital. And a lot of people complain about the credit scoring system. Again, it is what it is, right? Go learn how it works, because there are some really easy things to understand about the credit system. For one thing, you want to keep your overall credit card, your revolving accounts, below 30% max of your max. So if you have a $10,000 credit limit across your cards, no more than 3,000. But better still, no more than 10%. 10% is kind of the gold standard. So at 30%, you're getting a B. At 10%, you're getting an A. So try to keep it below 10% so that you get a better rate there. Don't go closing credit cards just because you paid them off. It's a bad thing. Keep it. Throw $20 on it every once in a while and pay it off. Don't go opening up a lot of new credit cards if you don't need them, because all that does is lower your score. Pay your bills on time and save up a deposit, a down payment, right? While you don't need 20% to buy a house, and I certainly don't expect, especially a younger person that may not have access to a lot of capital, to be able to save up 20%, I don't think that's good advice to wait. Mm-hmm. But if you have a way to put down 20%, you cut $150 off your payment simply, besides the saving interest part, simply by not having PMI.
What is a rate buy down? Oh, why would they be worth it? Because that can also affect when you're putting money down. Some people don't realize the certain money that you bring to the table when you purchase your property can dramatically affect what the normal interest rate is.
Yeah, so a rate buy down and a down payment are two very different things.
Yes. Okay,
they're both money, right? But a down payment is, let's say you're buying a $400,000 house and you're putting $50,000 down. You have a $350,000 loan. That's your down payment. What a rate buy down is if you want to think about the mortgage lending industry in general, they're looking for yield. They're looking for returns, right? So they are borrowing money at a certain rate and they're lending it to you at a slightly higher rate. And the spread between those two rates is what their profit is. And they need to make a certain spread. Otherwise, it doesn't make sense to lend, right? And the riskier you are, the bigger the spread they want because you're riskier, and the better you are, the smaller the spread they need, right? What a rate buy down is basically prepaying interest. So if you look at the life of a loan, you're going to pay X amount over that life. And by throwing some of that interest at the mortgage company up front without reducing the loan amount, you're basically prepaying interest. By prepaying interest, you actually get a better net interest. If you've ever looked at like a savings rate chart, right, or a loan chart, you'll see the interest rate and you'll see the annual percentage rate on a loan. They're two different numbers. The interest rate might be 6%, but the APR might be 6.1. Why is it different? Well, because there's other charges inside there. By prepaying some of that interest, you might drop your actual APY down to 5.9 or 5.85.
So both can really affect your monthly payment.
Absolutely.
Your down payment and that, just in different ways.
Correct. And there's two different kinds of buy downs that we can talk about too. There's short-term buy downs, like a 2-1 buy down or a 3-2-1 buy down, where you're buying down temporarily. It's a very different mechanism. So what that is that has to be done by the seller. It can't be done by the buyer. So you're literally getting the seller to give some money to the mortgage company. And that money is actually put into an account. And every month that money is credited, and it effectively lowers your interest rate. So your interest rate is still what it is, but it looks like it's lower for the first year because the seller's part of that payment is coming out of the seller's money that they set aside in the mortgage company to supplement your payment. So
almost
you
like a ticking time bomb. It's like you don't really get to feel it. You get some time to adjust.
But then after the first year, it goes up a little bit, and after the year 2, it goes up to the normal rate. So it's a good way to buy down temporarily to help you maybe get into it, but you still have to qualify for the full rate. Okay, you don't qualify for the lower rate.
You just have more time to save.
You have more time to get up there. Right. A permanent buy down is where you, as the buyer, pay the mortgage company directly a certain amount of money ahead of time to lower the interest rate
in total.
In total, that's forever.
Mm-hmm. Yeah. Okay. And how are the interest rates affecting homes in our area specifically? So a local question for us.
Well, and it's basically the same everywhere, but yeah, specifically here, we're higher interest rates slow the market down. That's literally what they're designed to do, right? By design, when interest rates go up, money costs more to borrow. When money costs more to borrow, what you're borrowing needs to be of more value, which usually means you have to get a better deal on it. So I think the higher interest rates stagnated prices, stagnated some of the speed at which houses are selling, and it's causing a slowdown of the overall market. Heck, 2024 was the slowest real estate market across the country since 1996.
Wow.
Now, prices did not decline that much. They went down a little bit overall, and in some places they went up, some places they went down. But that wasn't a crash. That's a correction or a flattening, if you will. This year looks like it's going to be a lot better. But it slows the market down, which is again what they're designed to do.
And somebody gets into a loan where they are, or if they were in what we saw in 2022, a lot of people refinanced.
Mm-hmm.
So talk a little bit about refinancing. How can refinancing later really save buyers money?
Yeah, it can. It costs money to do it though, right? Mm-hmm. So you have to look at that. That's where you have to look at it from a completely investor focused mindset, right? So if it's going to save you $50 a month to refinance, and it's going to cost you $3,000 to do it, right? Then if I can do math, I think that's about 150 months. It's a lot of months, right? Yeah. So you want to figure that out. Let's say a different number. Let's say it's going to save you $100 and it's going to cost you $2,000. It's going to take you 20 months to catch up on that, right? So if you're planning on staying in the house longer than 20 months, it might be worth it. If you're planning on leaving next year, it's definitely not. Yeah. Now, plans change, right? But you have to think about your plans. Do that math about return on investment. And by the way, it's going to cost anywhere from $3,000 to $5,000 because you do pay for a closing, you do pay some mortgage points, and so it's going to cost you money. It's not free. But if you're going to go from a 7.5% down to a 4.5%, then it's probably worth it.
Should sellers be offering rate incentives to buyers?
Yeah, that was a hot thing for a little bit when rates were like above 7 on average and even approaching 8 on occasion, to do the temporary buy downs. I don't see that as much. I definitely see that in the builder community. There was one builder I talked to the other day that actually is paying 5 origination points, which is 5% of the loan value, to the mortgage company to lower the rate, which brought effective rates down for that particular person from 6.5 almost to 5.5.
Wow.
Almost a full point and the builder was doing that as an incentive. Now, it's interesting. People ask, well, why don't they just lower the price? They don't want to lower the price. Okay, they do, but that's their last trigger. Yeah. They don't want to lower the price because other people just closed in that community 2 months ago, 3 months ago, 5 months ago, 10 months ago. They're going to be really mad if the builder suddenly starts discounting the house they bought. Yeah. So they'd rather give money away on the back end and keep the prices where they are.
And also having the disconjointed, interest rates are a different thing than the market itself. Mm-hmm. It's, you don't want the chance of the rates going down anyways, and now you tanked the prices of what your homes are worth.
Right.
So
once you start discounting the house, that sets the new value for the house. So they want to keep the house value up and give money away on the back end as much as they can.
The comparison analysis, buyers are not going to pay more than what something is worth unless some people will, but
yeah, some people do.
It's very rare. And 2 more questions. What are lenders not telling you about these rates? Anything that they're not telling you? Any juicy secrets that we should know from your knowledge?
I don't think most lenders, I can't speak for the whole lending community, right? Because there's a lot of people in it, but lenders are probably one of the most highly regulated industries that we have. There's a lot of laws around them. There's a lot of disclosure around them. So I think they're relatively honest. I think it's probably, if anything, you have to ask good questions, because there's maybe some lenders out there that won't answer questions you haven't asked, that they probably should.
Makes sense.
So I would say the secret is to A, get a good trusted lender, and B, learn to ask good questions of that lender, or have your agent do it.
They can definitely assist whatever agent you're working with. And if you need an agent and you're working in Central Florida, make sure to reach out. We'd love to talk with you and see what you're dealing with in your situation, and make sure to help however we can. Sure. If you do have any immediate questions and don't have time for a phone call, that's all right. You can go ahead and scan the QR code on the screen now, and make sure that you download our free Sunshine State Handbook. It has plenty of information, whether you're buying, selling, or investing in the Central Florida area. And we'd love to help you out wherever we can. We put a lot of work into that, hundreds of pages now. A lot of pages. And our last question are ARMs, or adjustable rate mortgages. Are they making a comeback, and should we be afraid?
Yeah. Adjustable rate is probably one of the triggers that caused the 2008 crash, right? And it's not that they're bad as a concept. They've been around forever. They weren't invented during that time where we were doing all the craziness. It was just part of it. And it was one of the things that triggered the problems, or caused it to be more of an avalanche problem. Because as your rate goes up, your payment goes up. As your payment goes up, your affordability goes down. And, rates could go up quite high in some of those adjustable rate mortgages. So I have tended to stay away from adjustable rates. I would never recommend somebody go get one. That doesn't mean it's not the right solution for a particular person in a particular situation. Just like balloon payments. I don't think anybody should ever get a balloon payment, but as an investor, sometimes that's the way you're going to get it. Most commercial loans have a balloon or have adjustable rates, right? Or a lot of them do. So, those kind of things are there. But there's been more adjustable rates as rates really rose. Some people opted to take the 1.5%, 2% cheaper adjustable rate, in the hopes that in the 3 years that it was controlled price-wise, that they were going to be able to refinance. It's a little bit of a chance, because what if they don't? What if they didn't? And they haven't really, right? So they may not be able to refinance, or that refinance may cost them more than they thought it would. So my advice would be avoid an ARM unless it's absolutely necessary.
So what I'm hearing is that interest rates are all situational. You should definitely, if you can buy and you want to buy and you need to buy. Don't wait for the market to dictate that. But if you can't afford to buy and you're scared of buying, maybe wait. But just know that it's always a risk. Even if you're buying your own personal home, it is still an investment.
Absolutely.
I've been Gabriel Burgos, and this is the Florida Real Estate Insider Podcast.
And I am always Tom McNamara.
And we will see you next time.